thank you to GCM Grosvenor and Resolute Investment Managers Inc. for sponsoring Series 3 of 2025. GCM Grosvenor is a global alternative asset management firm with a long-standing commitment to supporting small, emerging and diverse investment managers. For over 30 years, the firm has developed expertise in funding and guiding these managers as part of its broader activity across alternative investments. With over 20 billion in assets under management dedicated to small and emerging managers and 16 billion in assets under management dedicated to diverse managers, GCM Grosvenor leverages its experienced team, broad network and proprietary sourcing capabilities to support their success. Through the Small, Emerging and Diverse Manager Programme, the firm creates opportunities for investors to access a wide range of talent while seeking to drive strong returns and impact. Resolute Investment Managers Inc. is a diversified multi-affiliate asset management platform that partners with over 30 best-in-class affiliated and independent investment managers. Its unique platform delivers strategic value through a full suite of distribution, operational, and administrative services available to affiliates and partners.
The biggest thing I would say is I would tell the younger me is don't focus too much on the technicals. I feel like I spent too much time trying to focus on all the technical aspect things, but I would tell myself to ask more questions to understand the big picture better, which I get it now. It's hard to do without a lot of life experience, but that's something that really comes from reading more diverse set of books, reading about history. I would just encourage my younger self to kind of read more broadly than I did back then.
I'm Eve Van Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Henry Song, who's a portfolio manager at Diamond Hill, a $30 billion in assets under management asset manager headquartered in Columbus, Ohio. He joined the firm in 2016. Prior to joining Diamond Hill, Henry was a portfolio manager at JP Morgan Asset Management from 2005 to 2016. He specializes in securitized credit. Welcome, Henry. Thanks for joining me today.
Thank you for having me.
Well, let's start by talking a bit about your background. Can you tell us where you grew up, what you studied, and how you entered the investing business?
Yeah, sure. So I was actually born and raised in China. My family immigrated here when I was 13 years old. And at that point, really didn't know what I wanted to do. Up until college, I didn't really have a good sense what I wanted to do. I knew that I enjoy history, I enjoy numbers, specifically statistics. So when I went off to school, I was just kind of looking for a school that had pretty solid programs across the board. I ended up going to University of Michigan for my undergrad. And at that point, I still didn't know what I wanted to do. I think up until then, I've only read one investment book, which was a book about Warren Buffett. I thought it was pretty interesting, but there were a lot of other things that kind of interested me too. I think it's probably part of the fact being an immigrant and really didn't have any family member that's in the financial services business. My dad being a doctor always wanted me to be a doctor. My mom taught accounting in college, but she didn't really have much background in investment either. So it was kind of just more talking to people, trying to figure out what I want to do. I ended up going to the business school, not really because I wanted to go into business, but I just thought like this stuff was kind of interesting to me. I kind of view running a business as kind of solving a puzzle, thinking about different bits and pieces of a lot of moving parts. I think just having a lot of moving parts intrigued me more so than investing specifically. In fact, when I went to college, I really enjoyed marketing classes. I enjoy all the stories involved there, how it kind of really spoke to me. Whereas when I took finance, I literally had the worst grade in my college. I think it was the only class I did not get a better than a B in college. And that tells you how much I enjoy finance at that point. So I was pretty set on going into marketing. So I started pursuing an internship in marketing. And after about a dozen, I'm not kidding you, about a dozen interviews, I could not land a single internship at that point. And I didn't know why. I was getting desperate. I was like, okay, I need to do something. So I got an interview for an internship at a bank. And the first thing the interviewer asked me in that meeting was a brain teaser. And immediately my mind just clicked and everything worked out really well. And I got that internship. I was just reflecting on that. I was like, wow, this is so funny. Like I really enjoy this type of interview, despite the fact I want to go to marketing, but I really sucked at all the behavior interviews. I didn't know what was the right thing to say, I guess. Just being myself wasn't enough in that sort of interview. So that's kind of how I accidentally kind of got my entry into not even in the investment business, but kind of into like the heart of finance. So at this particular bank, it was a commercial bank, but I worked in the treasury department. And the group I was working with specifically, they were hedging their mortgage interest rates for the bank. That was the first time I got exposure to what's mortgage-backed security, interest rate derivative swaps, and all of those fun things that I probably didn't pay attention to in finance class. That was my entry into the space, and I really liked it. I think the way the math involving the mortgage space really just spoke to me, and I thought that was pretty interesting. So after college, I decided that I am going to start looking to asset management firm as a career, but I still had a lot to learn. I still didn't know what all the jobs were available at that point. And the one job that came to my attention was a portfolio specialist role, well, being the analyst to a portfolio specialist, because I thought that at that point, that was the perfect blend of what I wanted to do. You kind of touch on investments a little bit, but you don't have to be smart enough to actually do the investment, but you get to kind of explain investments to the clients, which is kind of fun to me. And then you get to travel a lot. That's something I was really interested in. So that's what I thought was a perfect blend. And frankly, at that point, another reason for me not wanting to get into investing directly was I didn't think I was smart enough. Partly because how I did in my finance class, partly because I was intimidated by the fact I had to take this dreaded test called the CFA. I just had no interest in pursuing this career, but I figured I could try to explain things to people. So that's how I got in my entry. At that point, I got a job at JP Morgan. It was just right after the Chase and Bank One JP Morgan merger. So I was the first analyst hired in the Columbus team. I had a really successful 20 plus year track record team at that point that was doing really well. I was hired for that team as their first analyst supporting all the portfolio specialists. So that was kind of my entry into JP Morgan and the asset management business.
Just going to follow up. There's some really interesting strands there we can follow up on, and I just sort of flag them here. I think one is the idea that you think you're not smart enough for finance. I think that's probably, we do ourselves. Think of the number of candidates we must turn away with the illusion that it's actual book smarts that matter in finance. When, as you know, those marketing skills, that storytelling, that connection is just is probably equally as important, and problem solving, which can come from any discipline. I also think it's interesting the behavioral interviews that maybe weren't right for you. How many candidates we turn away because we interview the wrong way. And maybe we can get to that a little bit later in the discussion around diversity, etc. But just wanted to pick those up, and you can resume. You were going to, I think, take us on the next step after JP Morgan.
Yeah, no, absolutely. I think, yeah, I do like to talk about this a little bit more later too. So I started at JP Morgan, but one of the things that happened was I got bored right away. I thought the job was super easy. I was like, why do these banks hire people with good pedigree and give them like high school level work on a daily basis as training? It just didn't make a lot of sense. I was getting pretty bored. The market was kind of boring. Fixed income investing was not exciting. Mind you, this is 2005, right before the financial crisis. The market just wasn't very volatile. It was one-way train. It's all about taking as much risk as you can. And then really what changed for my career at that point was a couple of things. A was the financial crisis coming along. And B was when I spent a couple of years on the trading floor sitting next to all the portfolio managers, I started realizing I have what it takes to do the job to be a PM. Kind of to what you said, once I started interacting with those portfolio managers, my preconceived notion, what it required to be a PM really changed. I see them as normal people at that point. I didn't think they were somehow smarter or better. And I was like, okay, I think if I, not in a bad way, but like if I see people that's sitting next to me, all these people can do it, I think I can do it too. I don't feel like they're any smarter than me. So that kind of in some way gave me a sense of confidence. And then there was a retirement on the team. I had the opportunity to kind of jump in as a junior person. And that's right before the financial crisis. And then, of course, financial crisis happened and things really just took a turn. Market became extremely interesting. And it felt like it was kind of training by fire at that point. Every day was literally different for a while, for a couple of years at least, before people knew what was going on. So that's kind of like how I got started in my career, and now I'm still doing what I did.
I love the way you referred to that problem solving piece as the bit that clicked because I've heard business, the whole process of doing business is just being described as a series of problems to solve. And I'd love to now translate that line of thinking into fixed income investing. Like, what are the problems or what are you solving for in your role as a fixed income portfolio manager today?
Yeah, I think for fixed income investments, right? Like I think you have to understand that investing in fixed income is not a way to get rich, right? In a lot of ways, people look at fixed income for preservation, as a hedge in the portfolio, as part of the asset allocation. So understanding the role it plays in individuals' portfolio matters a lot. So I think you have to approach it with a different sort of mentality. So to me, the problem you solve also varies by each investment guideline. There are different objectives what you're trying to do. And it's really trying to find the least risky way to deliver the results that your clients are asking is the puzzle you're really trying to solve there. I don't think you need to take on excess risk when the clients are not expecting that. So really trying to align your investment process and philosophy with what the clients are really expecting out of you is very important in fixed income investing.
And in this very moment in fixed income investing, so we've had a bit more volatility than we are used to, perhaps clearly a rate rise environment that's been all down and then up and now kind of on pause. What would you say is at the forefront of your mind as you navigate in your particular area? And what is it that your strategy does? Securitized credit, perhaps that is characteristic today. Is it a liquid market, for example? Do you get the good counterparty risk? Is it less than it was maybe during the crisis? Can you just kind of paint a picture of that market?
Yeah, I think the most important thing right now, the number one question everyone is asking right now is where's the interest rates going and what is the shape of the yield curve? Right. I think there is a pretty big difference between what the Fed can control on the short end and where the long end rate's going to be, which is directly related to the status of US dollar as a reserve currency for the world. I think those questions, they have come up in the past, but not to the extent they have come up today. I think that's at the forefront of every fixed income investor's mind is how do you manage this exposure and what is the shape of the curve going to be to figure out all the impact with all the macroeconomics that's going on. I think that's in the securitized market, it's a little bit different. It's a much, much smaller segment of the overall fixed income market. It always has its own quirks. The big thing right now is understanding how all of the exposures in that space are related to all the macro environment what that's going on. Meaning specifically, in the securitized space, you're dominated by residential mortgages. Then you're followed by various asset-backed securities, which is predominantly dominated by exposure to individual consumers. So I think it's really trying to understand how all the stuff that's going on in the macro impacts people on the micro, on the individual families, and all the decisions they may have to make with all the debt that they currently have. So I think it's a little bit different dynamics than how the corporate sector may look at it, because you're talking about individuals that don't have the balance sheets like a large corporation. They can't really ride out some of these storms. So how would they fare? How would all the credits perform in the next? You're not talking about next few years. You're really talking about next 3 to 6 months, especially with looming potential job cuts and other things that we talk about when we enter into a recession here. So those are kind of at the forefront of the mind for, let's say, securitized portfolio managers.
And in terms of just the nature of that market versus, say, 08, 09, would you say there are any safeguards in place in terms of, say, contagion or overconcentration, maybe with certain counterparties or just anything? How is the market different from 08, 09? Is it still as exposed?
Yeah, I think the big difference with what happened in '08 and '09 is we don't have the leverage that was in the system back then. We don't have banks with huge leverage to these asset classes that can potentially cause a systemic issue. So that's really good. And the underwriting standards across the board has gotten much, much better. And I would say what the CFPB has done in the past, all these different financial rules, that people have a better understanding with the debt they're currently taking on. So there is a more financial literacy for people who have taken out these debt. So that's a huge improvement that we've seen over, I mean, it's almost 20 years now. So that's a big improvement. But ultimately, you are still looking at assets that's very highly correlated to the overall economy. So there's no way to really avoid that. Should we enter a recession, unemployment rises, it's going to impact the sector just like every time we enter into a recession.
And just in terms of your own maybe core beliefs as a fixed income investor, are there any that have stood the test of time? Are there any that you're starting to question now? We talked about the yield curve before, and it didn't really give us the forecast of a recession, although many thought it would. Anything that's, as I said, that's maybe core and more variable right now?
Yeah, I think it's probably a little less specific than the yield curve. To me, I think one of my core investment belief is you have to understand what you're trying to deliver to clients, and you have to have a repeatable process to do that. I think that's very, very important because market environment's always changing, but the process, how you approach your investment, that should be something that can withstand the test of time. And to me, the other thing that I think is very important too is everything that I invest in, I want to understand what it is. I would say that if you can't explain what you're doing to someone outside this business, you can't explain to them why you're doing X, Y, Z, then you probably don't understand well enough and you probably shouldn't do it. I really don't think investments that overly complicated when you're handling other people's money. I do think you want to understand what you're doing there. And I think the other thing that's also important to me as an investor is I want to be able to say, I don't understand. Knowing when to say that is also very, very important. Because too many times we have seen people chasing the market without really understanding the risk. We have seen that in the retail space. We have absolutely seen that in the institutional space. We just talk about what happened during the financial crisis. I don't know if everybody appreciates the risk that we're taking on when they invest in the subprime mortgages. So I think it's very important to really understand what you're doing and not chase what's hot. And also not have the fear that, you're kind of missing out on things when you're not doing that.
So interesting. And I think now we can return to that other topic earlier, just about that complexity that finance exudes that can be quite off-putting for some people, because one of the core missions of this podcast series is to showcase just how diverse talent is in the industry already. Different backgrounds, different sort of schools of thought, different models, I suppose, of careers that really all converge in our industry. Any thoughts you have maybe on what you've been through in terms of maybe being an unlikely or accidental entrant into finance, about how we could make it a more diverse industry?
Yeah, I think we have seen a lot more diversity in the industry since I entered the business. And I would say it's gone much better, albeit it has a way to go in terms of racial diversity and people coming from a little bit different backgrounds. But one of the things that kind of still stood out to me, so at Diamond Hill, we do multiple different personality tests when you join the company, and we kind of map it out. And what stood out to me is almost majority of our investment teams fall into one or two categories. Depending on what test you're doing, Myers-Briggs or you're doing Enneagram, people tend to fall into a couple buckets. And that's pretty much the entire makeup of the investment team. I specifically remember when we did the Enneagram, I was the only number 4 in the entire company, let alone the investment team. So that's just something that's very different. It's not seen to be a desirable trait. If you read a lot of books and stuff, it's like, okay, you have this sort of personality. This is not the job you should go into. So I feel like a lot of times we push people away, not intentionally, but the industry kind of draws certain type of people, which makes sense to me, like what the type of people you draw. But that can become off-putting to those who kind of view the world a little bit differently, who has a little bit different personality traits. So I do think that is something that's a little bit challenging, and it doesn't come with just increasing, like, say, racial diversity, because, you could draw people from different racial backgrounds, but then you end up drawing the same personality types into the industry. And that doesn't necessarily increase the diversity that you're looking for in a meeting room. You want people to have different takes. You don't necessarily get that.
That is absolutely fascinating, because I've heard your argument made, but not with personality types, but with socioeconomic diversity. But I think the same challenge could be put to that, which is to say you can have people from the same socioeconomic class that have radically different personalities. So just purely solving for socioeconomic diversity is also not going to get you the different way of thinking. Just for those of us who are like me, having to now look up what the 4 personality type is, can you tell us what that is in terms of it being rare in finance, but maybe more commonplace in other professions?
Yeah, the 4 is really, sometimes they call it individualist. People kind of have their own way of looking at the world. It tends to be people that end up being in more of an artsy space sometimes. It's not, your typical, your investigators, your analytical mind. So it's kind of not the type of people you typically think of. it's my dominant trait in that test, but like, I do borderline some of the other analytical part of it, but it's probably explains why, like, investing was not something I was attracted to as a kid. It was just, I thought it was kind of, it's fun. I see it, like, honestly, I still think as I'm solving a puzzle every day, it's kind of fun. Just something that's a little bit different. I mentioned earlier, I don't really read investment books before I enter the business. Now that I am in the business, I still don't read investment books that much. I feel like I spend all day doing this. I want to learn about other things that's kind of interesting, learn about nature and other stuff. So that's kind of that four is just, I don't necessarily conform to the typical analytical mindset that people may have.
That's so interesting. And then just getting back to the interviews. So this kind of behavioral interview that may have been for the marketing jobs, but still, I think we probably have a different kind of behavioral interview, perhaps for finance. Any suggestions as to how we can do better? Maybe whether it's through using more of these tests that you mentioned, maybe it's through actually deliberately seeking out a balance around the wheel, if it's the color wheel or the number wheel in this case. Anything that you've seen that's kind of working, maybe if you look at other organizations or Diamond Hill itself?
It's really hard because you don't necessarily just want to find someone because they're different, right? Because I think you have to face with the reality that you are going to be working with this person you're hiring. So if you hire someone who's completely different from you and you have a hard time working with them, that's not necessarily an ideal solution either. As I look at my team right now, I feel like we have a pretty interesting collection of folks. But then it's also the fact that it's kind of sometimes it's accidental. Like the way we have done hiring over the years and the type of people we hired at the different points of our growth story just didn't necessarily attract the prototypical investment type, if you will. Meaning, like when we came to Diamond Hill, we basically didn't have any assets on the fixed income side trying to build it out. You really couldn't attract a lot of established folks. So we took a lot of opportunity on people that, again, may not be able to get a job at an established firm right out of the gate, that may not have the resume at the time. So we took a few flyers and they worked out really well for us. And I think that we have kind of have a collection of personalities now that's pretty unique to us. I really like that about us. But I think if you are an established team with a lot of folks tend to think similarly, it will be hard for them to force say, hey, hire someone that's very different from the rest of the team. That's not going to go over very well for anyone in that situation. So it is a very tricky, it's challenging. I don't have a great solution for that, unfortunately.
I don't think any of us does, but it's certainly good to try some on for size and at least to hear about other approaches. I'd love to go to some more personal reflections now, as we've certainly had a nice littering of personal reflections already throughout this. But when you look back at this career that took some interesting twists and turns and generally turned out for the best, it seems, were there setbacks and challenges in there that you'd learned lessons from, maybe that you can share?
Yeah, I think there were definitely a few interesting time periods I invested through. Starting out, the great financial crisis, I was just getting started. Then when that happened, I didn't know what to do, right? I was just looking at what other folks were doing around me and trying to learn from them. In hindsight, when I look back, I think everyone was just getting too scared. I think oftentimes we were too scared to even, when there were good news that were happening, people were very slow to accept that things are turning a corner. And I think the fear mongers that were out there, I think really scared me for a very long time. So when I look back, I really felt like I missed a lot of great opportunities along the way. That was a time to be more aggressive. I think that looking at how some of the seasoned veterans have done during that time, that you really see like how people really understood the cycle, understood that was a time, that was like once in a lifetime opportunity to really invest during that time. And so I totally missed that boat. I think the other thing was COVID, the initial lockdown of COVID in March of 2020. That was extremely challenging for our investments at that point. It was also very unique. It was really the first time I have seen an entire sector of the market seize up for a couple of weeks. That was a time when most of the ABS and CMBS marketplace completely shut down with no liquidity, no dealers making markets. That was just something I've never experienced before. We declined redemptions at that point. Clients were panicking, not knowing what to do, and that was fly to cash. I think the biggest thing I took away from that is it was really worth getting to know the clients when you onboard them to really understand kind of how they use the products. And I spent a lot of time talking to clients at that point. Everyone was panicking, myself included, but I think it was just still trying to find the most sane, the analytical voice at that point, trying to figure out what's what and try to convey to people and calm the fear was very, very important at that point. That was definitely not something I've experienced before, but that's something, I feel like I've really taken to understand. And when I talk to clients or prospective clients after COVID, I really try to understand who they are, how they like to think about things, how they plan on utilizing our strategy, and what we need to do to give them more comfort, maybe in situations like a COVID, or in the current situation, can we give them a perspective heads up on how we're thinking about things so they don't panic and they don't necessarily make a knee-jerk reaction and do something that's not beneficial to them or to the rest of the fund holders.
Some profound lessons there, I know, and I think we still draw upon them, even though the crisis today may be a little different. Just before moving to the last question or two, I'd love to ask a question. It was not on the script, but I think it might be insightful, and it's not a political question, but it's more to do with being from China and having lived there for 10 years or 12 years, I think, and you have your family from China. Clearly, you have a deep cultural understanding. And here we are in the middle of a trade war. Would you say there's anything that we're overlooking, maybe, from our lens in terms of China and its likely whether response, retaliation, or just, something that any insight that being Chinese perhaps gives you about how this is playing out?
I think the first thing that jumps to my mind with all this tariff talk right now is people forget the fact that China is not a democracy. So Xi Jinping has all the power there. And when it comes to negotiating, he has a lot of leverage. If you look at the Chinese history, there have been long periods of suffering, and a little bit, hiccup along the road here is not something that's going to deter them. So I think they have a pretty strong hand at this. I read a lot of people saying how this tariff is going to really hurt the Chinese economy, which is absolutely true, but they don't realize in a society like that, in a political regime like that, they are more able to withstand the backlash of the tariff war than we're able to at the US. That's a huge difference. And I think number two is I think people often forget the fact that the Chinese people, despite all the economic growth we've seen in the last 20 years, when you compare to the rest of the world, is still not poor, but like when you look at the income per capita and all the metrics, they just still feel deeply that they have a long way to go. And we tend to forget that, thinking somehow they have kind of made it. So I think when we talk about the imbalance in the trades and everything else, I think it's good to be reminded that the people there simply wants to have a better living standard, live a better life, and trying to move their living standard a little bit closer to what we currently have in the States.
Really insightful. Thank you for sharing that. And I think it's always good to reaffirm that something that we've heard such say about, I suppose, the pain threshold, which is, I think, what you referred to there at the beginning. I'd love to ask now just on reflections. So we've spoken about some of the serendipitous interviews and people you met and maybe, being in the right place at the right time around, say, a portfolio manager's retiring. Were there any key people who influenced you along your career journey?
Yeah, certainly my former boss and mentor, Doug Swanson. He was the lead PM, head of the fixed income team there. He was definitely very influential. He took me under his wings essentially and really mentored me through. So I learned a lot of my investment skills from him. I would say the biggest thing I also learned from him is he was always a belief that stick to what you know and stick to what works. Don't necessarily try to chase things. And simplicity works better than complexity. And I think that's one thing that he will probably really stress is investment in mortgage-backed securities is not that complicated. There are a lot of data, a lot of numbers. Like if you look at a mortgage bond, I can throw at you 100 different data points. You just have to know which ones really make sense and really focus on that. And don't get drawn into all this overly complex analysis, right? I think that's one of the things I realized I could do this job. I mentioned earlier, I see some of the people being PMs, what they're doing. One of the things I realized is being a portfolio manager in fixed income and in securitized products, you don't need a PhD in math. You don't need to understand all the super complex ways of investing, right? Like I think you can work if you find your niche, you find your process. So I think that was hugely influential for me and also hugely comforting that, again, like I can actually do this too. I think when I see some other people's investment strategy, I will even admit I don't fully understand it. I've been doing this for a long time. I can't say I fully understand the thinking behind all the stuff. And does seem super complex, right? I just take comfort in the fact that, okay, look at our performance. What we're doing makes sense. It works. Let's not make it overly complex. So he's someone that was very, very influential for my career growth.
I love that. I'll return to that theme when I sum up, but I love the tale you weave of the world of finance that actually sits side by side with some of the illusory world of finance that is super complex and inaccessible. The last question is around any creed or motto you live by. And I think it's wonderful how you've illustrated where you get your motivation, and it's not always from investment books. Any advice or creed or motto that you can share with us, or advice you would have for your younger self?
Yeah, I have always thought people have often say, finance at the end of the day, it's a people's business. And I, always thought that's to mean like relationships and all of that, which I think is very much true. But what I would like to really think I learned from others, right? This including faith leaders and other people, books I've read, is really trying to not draw a lot of absolute and really trying to see people as humans. So try not to get overly high or low on anything that people have done or say, and to really trying to approach it from a more humanistic view to everything that I do. I would like to see the good in people. I would like to say a lot of times I notice that numbers can be cut and dry, but people are not. So people don't necessarily make the most irrational decisions. And how it relates to investment really is the market is oftentimes driven by fear and greed. It's not driven by the most sane analytics. Otherwise, we can have a computer just run the world at this point. The reason that market doesn't behave that way is because it's all people behind each individual screens pushing a button, doing something that's a little bit different. So I think understanding that to me is something I really want to kind of get better at, really just trying to understand the counterparty I'm working on a trade with, where they're at, if I'm talking to a banker, issuer, really just trying to understand the human aspect of all of these things. And you mentioned what advice I would have for my younger self. The biggest thing I would say is I would tell the younger me is don't focus too much on the technicals. I feel like I spent too much time trying to focus on all the technical aspect things, but I would tell myself to ask more questions to understand the big picture better, which I get it now. It's hard to do without a lot of life experience, but that's something that really comes from reading more diverse set of books, reading about history. I would just encourage my younger self to kind of read more broadly than I did back then. That would have suited me really well if I read more broadly back then.
It's so interesting. And then I has me asking the question, that Steve Jobs said you can only join the dots backwards. So I wonder, when you read broadly, does it mean the same as it with reading broadly now, when you can actually draw some of those links between it? So it's really interesting. And I love the humility that has been a hallmark of this interview, I think, and the demystifying too of a world of finance, which is sometimes it's in everyone's favor to keep mysterious, technical, and that kind of wall-like presence. And I just wanted to ask you one last thing, which is just really whether you agree with this, which is it was actually came from somebody called Brian Portnoy, who's written about the shaping wealth, and he's written a lot about the behavioral advisor. And we asked him, well, what if a client comes and says they want to be buying bonds? And his point was, well, what is the question behind the question? Meaning, are they really saying they want an income stream? They want more security. They want maybe less volatility in the portfolio. That in a way, that's the point. And I think you've sort of touched on that in terms of the more human side of finance. Is that something when you're dealing with clients, you're trying to get at what they're really trying to solve for in their fixed income investments?
Yeah, absolutely. I like to talk to prospective clients and existing clients, really trying to understand. I often ask them, what do you see the strategy doing in your overall portfolio? What are you trying to achieve with this particular strategy you're looking at? How does it fit? And I will straight up tell them if it's a good fit or bad fit at times, because last thing you want is, someone uses your strategy and turns out they're not pleased with the results, right? For whatever reason. And of course, for example, our salespeople are not going to voluntarily tell you all the potential risk along with it, right? But you want clients to have the best experience. So I want to set the expectation correctly as well for every strategy. What to expect in terms of volatility, what to expect in terms of liquidity. Just kind of lay that all out there. I do think the more you can get the heart of the question to really understand what they're looking for, and you're going to have a better long-term client experience with that prospect. So I do think that is a very, very important question to discuss before onboarding any prospects.
Well, thank you so much, Henry. I've snuck in a lot of extra questions there because I thought this was going in a fascinating direction. Thank you so much for coming here and sharing your insights with us.
Thank you very much for having me. I enjoyed it.
I'm Aoife Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts. You can find all of our content on the 50 Faces Hub, where you'll find a library of role models, resources, and other solutions to enhance your career. This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organisations and affiliations of the host or any guest.